Hey everyone, and welcome back to the Deep Dive. Ever looked at a company's financial statements and wondered what truly makes it valuable beyond, the obvious factories and inventory? Today we're taking a plunge into the often invisible world of intangible assets, those crucial yet sometimes elusive elements that can make or break a business.
Indeed. We're going to try and demystify the accounting behind assets you can't literally hold in your hand. Things like the power of a globally recognized brand name or the complex software running our daily lives. This deep dive is hopefully your shortcut to understanding their profound impact and precisely how they're accounted for on a company's books.
Our mission: to take some dense, pretty technical financial accounting sources and, well, extract the most important insights. We want to help you see what's really behind the numbers, especially those intriguing indefinite-lived intangibles. We want to peel back the layers and make these concepts not just understandable, but, genuinely interesting. So let's unpack this. All right, let's kick things off with the absolute basics. When we talk about intangible assets, what exactly are we referring to?
Okay. So our sources define them as long-lived legal rights and competitive advantages that a business either develops internally or, more often, acquires from another entity.
So the unseen engines of value.
Exactly. They can really drive a company's success. Think about things like patents that protect groundbreaking inventions, copyrights for, say, software code or books, or even franchises that grant specific business rights, like a McDonald's franchise, for instance.
Right, and those are specifically identifiable. You can point to them.
Correct, because you can clearly identify them. There's a contract or a legal right. But then we have this very special category called goodwill, which is sort of in a league of its own precisely because it cannot be separately identified.
Okay, goodwill. We'll definitely come back to that one. But first, why are these intangibles so important, especially today?
Well, what's particularly interesting here is how dramatically the economic landscape has shifted. Today's economy is increasingly fueled by technology, intellectual property, data, brand loyalty. These unseen assets often represent a company's absolute true competitive advantage. They're not just abstract concepts. They contribute enormously to a company's future earning power, even though they lack any physical form.
So, like a pharmaceutical company's patent on a blockbuster drug, that's probably worth more than their factories.
Absolutely. That patent, while intangible, is the legal shield allowing them to generate immense revenue, often without direct competition for years. Or think of a tech company, their algorithms or customer data might be far more valuable than their office space.
That paints a really clear picture. Now let's delve into a truly fascinating distinction you mentioned: the concept of an indefinite life for some of these intangibles. I mean, we're used to thinking about assets like machinery wearing out or patents expiring. How can an asset literally have an indefinite life in accounting? Does it actually last forever?
Well, accountingly speaking, yes, kind of. An intangible asset is deemed to have an indefinite useful life if there are no contractual, legal, economic, or, any other limiting factors that restrict how long it will contribute economic benefits.
Okay, so unlike a patent that expires after, say, 20 years.
Exactly. A patent has a finite life, so it gets amortized over those 20 years. But something like a trademark or a really powerful brand name like Coca-Cola's could theoretically last indefinitely as long as the company keeps using and protecting it. There's no built-in expiration date.
And the big accounting impact of that is,
No amortization. That's the critical point here. Without a defined life, you can't systematically spread their initial cost over time through amortization, which is what you do for a building or machinery that clearly wears out. This means their carrying amount, what it's valued at on the books, basically its cost minus any prior write-downs, stays largely the same unless something happens to diminish its value.
so no regular write-down. That's a huge difference.
Yeah.
And you mentioned goodwill earlier. Let's circle back. It often seems like the biggest intangible on the balance sheet, but it feels so abstract. Why is it such an enigma?
Yeah, goodwill is truly unique. It represents the intangible resources and elements connected with an entity that, unlike a patent or brand name, cannot be separately identified and reported. Think about it. How do you put a precise dollar value on a company's amazing management team? Or its deep marketing expertise? Or the collective technical skill of its employees? These are incredibly valuable, right?
Absolutely.
Yeah.
But you can't just list great management as an asset line item.
Exactly. So when one company buys another, the premium paid above the fair value of all its identifiable assets, both tangible and other identifiable intangibles, becomes goodwill. It essentially captures the excess earnings power of the business. The idea that the whole is genuinely greater than the sum of its individual parts. It's the synergy, the reputation, the customer relationships, the operational efficiencies, all that good stuff that's hard to pin down but contributes to future profits.
So it's like the secret sauce. The value of a well-run operation that just works better than its individual pieces would suggest. Like buying a successful restaurant, the goodwill is the loyal crowd, the smooth kitchen flow, the buzz, not just the tables and chairs.
Precisely. To connect this to the bigger picture, goodwill really captures that holistic value. It's the intangible premium an acquirer pays for a successful established business, recognizing that its combined strengths will generate higher future profits than just buying the asset separately. You're paying for future potential that's already there.
Okay, so goodwill is clearly important and often huge. But our sources stress something crucial. Internally generated goodwill cannot be capitalized. So if Apple builds an incredible brand from scratch, that value doesn't appear as goodwill on its own balance sheet. It only shows up if they buy another company.
Right.
Why the strict rule? Seems a bit weird.
Yeah, this raises an important question, and it boils down to two key accounting principles: objectivity and verifiability. How would you reliably measure your own internally generated goodwill? What benchmark would you use? It's incredibly difficult to put a precise, verifiable number on your own company's reputation or management skill. Allowing companies to capitalize internally generated goodwill would just open the floodgates to subjectivity, wouldn't it? And potentially let companies artificially inflate their assets.
Okay. Too easy to just make up a big number.
Right. So goodwill only gets onto the balance sheet when it's purchased in an arm's length transaction.
Arm's length.
Yeah. Just a deal between two independent, unrelated parties, each acting in their own self-interest. This ensures the price paid is a real market valuation, giving accountants an objective, verifiable number to record. Much better than trying to value your own reputation internally.
Got it. Prevents companies from marking up their own homework.
Yeah.
So walk us through the mechanics then. How does this purchased goodwill actually arise and get recorded in these business combinations?
Sure. There are two main methods, depending on the situation. The first is under the acquisition method. This is the standard when you're preparing consolidated financial statements, typically when one company acquires another and gets full control. In this case, goodwill is calculated as the excess of the acquired entity's total fair value, basically the purchase price over the fair value of its net assets.
And net assets is just assets minus liabilities, right? Including all the identifiable stuff.
Exactly, assets minus liabilities. And critically, that includes valuing all the separately identifiable intangible assets of the company being bought. Its patents, customer list technology, whatever you can identify and value.
So you buy a company, value all its bits and pieces you can identify. Buildings, cash, patents, debts. And whatever's left over from the purchase price, after allocating value to all those. That's the goodwill. The remainder.
That's the gist of it, yes.
Yeah.
That residual value, the premium, is goodwill. The second method is the equity method. This applies when an investor buys a significant chunk of another company, usually like 20 to 50% ownership, gaining significant influence, but not full control. In this scenario, goodwill is the excess of the stock purchase price the investor paid over the fair value of the proportionate share of the net assets they acquired.
Significant influence, meaning you have a say, but don't run the show entirely.
Okay, so why the two different calculations? Why not just one way? It really comes down to the level of control and the reporting requirements that follow. With the acquisition method, you're buying the whole company, essentially. You consolidate its financials into yours. Assets, liabilities, revenues, expenses are all rolled up. So the goodwill reflects the entire premium for that whole entity. With the equity method, you only bought a stake. You don't consolidate their full financials. Your investment shows up as a single line item. So the goodwill calculation reflects the premium just for your share. It matches the accounting treatment and the degree of ownership.
Interesting distinction. Okay, so once you've got goodwill on your books from buying someone, how do you maintain it? Do you add to it every time you hire a star CEO or run a brilliant ad campaign?
No, absolutely not. And this highlights another key principle. Costs associated with maintaining, developing, or restoring goodwill are not capitalized as goodwill. They're just expensed as incurred.
So you can't capitalize your ongoing efforts to build your brand or improve operations.
Nope. Those are just considered part of your day-to-day operating costs. If you want to increase your reported goodwill, generally you need to go out and acquire another company that brings more of that excess earnings power. Ongoing internal efforts are vital for success, obviously, but accounting standards say they're too hard to reliably measure and add to existing goodwill.
Okay, so we've established that indefinite-lived intangibles, like goodwill, aren't amortized. They just sit there on the balance sheet. But what if their value tanks? How do we make sure that reported value is still accurate if it's not being gradually reduced?
Right, and that's where impairment testing is absolutely critical. Because these assets don't wear out predictably, we have to regularly check if their fair value has fallen below their carrying amount, what they're listed for on the books. It's a basic principle. Assets shouldn't be carried at more than their worth or what they can generate in future benefits. So these indefinite-lived assets must be tested for impairment at least annually. It's a vital safeguard.
Annually. Got it. So how does this impairment testing work? Let's start with indefinite-lived intangibles other than goodwill, like a trademark maybe. Walk us through that.
Certainly. For those, there's a two-step process, although the first step is optional. Companies can choose to perform a qualitative assessment first, sometimes called the sniff test.
Sniff tests.
Yeah, basically the goal is to figure out if it's more likely than not, meaning a greater than a 50% chance that the asset is impaired. It's a judgment call based on various indicators.
What kind of indicators? What red flags are they looking for in this qualitative check?
They look at a whole range of things. Cost factors like unexpected hikes in raw materials or labor that might make the asset less profitable. They scrutinize financial performance. Are cash flows negative or declining? Are there unexpected losses? Then there are legal, regulatory, or business factors. Maybe new regulations hurt a franchise's value, or a legal challenge clouds a trademark's future. They also look at entity-specific events like major management changes, shifts in strategy, big lawsuits, or even thinking about bankruptcy.
So internal stuff too.
Right, and industry and market considerations are huge. Is the whole market deteriorating? Is competition way up? Have market values for similar assets dropped? Is customer demand falling? And finally, macroeconomic conditions like a recession, tight credit markets, or big currency swings. If, after looking at all that, they decide it's not likely the asset is impaired, they can stop there. No need for the quantitative test that year.
So it's a filter, a way to avoid unnecessary number crunching if things look okay. But you said they can skip this, bypass it.
That's right. They have an unconditional option to just bypass the qualitative step and go straight to the quantitative impairment test. If they skip the qualitative, or if the qualitative assessment does suggest impairment is likely, then they must do the quantitative test.
And how does that quantitative test work for these non-goodwill intangibles?
It's pretty straightforward for these assets. You compare the fair value of the intangible asset, what it could be sold for today, directly to its carrying amount on the books. If the fair value is less than the carrying amount, boom, you recognize an impairment loss. The loss is simply the difference between the carrying amount and that lower fair value. And what's interesting here, as mentioned in the sources, is that it's generally not really possible to reliably estimate total future cash flows for these types of indefinite assets, so we rely heavily on this fair value comparison.
Okay, direct comparison. Simple enough. And when that loss happens, where does it go? Hits the income statement, I assume. And can you ever reverse it if the value bounces back later?
Yes, it hits the income statement directly. It's reported as a component of income from continuing operations before taxes, so it reduces profit for that period. And at the same time, the carrying amount of the asset on the balance sheet gets reduced by that loss amount. Now, your second question is crucial. This raises an important point. Why is restoration typically not allowed? Generally, once an asset is written down for impairment, accounting standards prohibit restoring that value later, even if the fair value recovers.
Really? Even if the market completely recovers?
Generally, yes. It's a conservative accounting principle. It prevents companies from potentially manipulating earnings by writing assets down and then writing them back up based on market fluctuations, creating sort of paper gains. The only tiny exception mentioned is if the asset is specifically held for disposal. So for the most part, impairment is a one-way street downwards.
That's a really important detail. Enforces conservatism.
Okay, let's switch to goodwill impairment. Also tested annually, also indefinite lived, but you said it's different tested at the reporting unit level. What's a reporting unit, and why that difference for goodwill?
Right. Goodwill isn't really a standalone asset. It's inherently linked to the specific business operations that generated it when it was acquired. So the impairment test is done not just for the goodwill account itself, but for the entire business unit it belongs to. A reporting unit is defined as an operating segment, or sometimes even one level below an operating segment. Think of a large, diversified company like a conglomerate with separate divisions for tech, consumer goods, healthcare. Each of those might be a reporting unit.
Oh,
To connect this to the bigger picture, this means goodwill can be impaired in one struggling part of the company, say, its retail division tanks, while other parts, like a booming tech division, remain perfectly healthy and their goodwill isn't touched. It allows for a much more granular assessment. That makes a lot of sense. You isolate the problem. Does goodwill impairment also have that optional qualitative sniff test?
yes, absolutely. The qualitative assessment for goodwill impairment works very similarly. A company can choose to do that first, look at all those same factors we discussed, and decide if it's more likely than not that the reporting unit's fair value is below its carrying amount, including goodwill. And again, they have the unconditional option to bypass this and go straight to the quantitative test if they prefer, or if red flags are already obvious.
Okay, so if they go quantitative for goodwill, how does that test work? Is it just comparing the reporting unit's fair value to its carrying amount?
It's similar, but with a crucial difference and that critical cap we need to remember. Impairment exists when the carrying amount of the entire reporting unit, and this includes its allocated goodwill, exceeds its fair value, which also includes the goodwill value. So you're asking, is this whole business unit, including its goodwill, still worth what we have it down for on the books? The impairment charge is the amount by which the carrying amount exceeds the fair value. However, and this is the vital cap, the impairment charge recorded cannot exceed the actual amount of goodwill allocated to that specific reporting unit.
Ah, okay. So the write-down can only reduce the goodwill balance itself. It can't spill over and reduce other assets in that unit.
Precisely. This cap is crucial. You can only write goodwill down to zero, you can't go below that, or use a goodwill impairment calculation to indirectly write down other assets.
Let's make this concrete. Tell us about that Omega Inc. example from the sources. How did the reporting units Alpha and Beta fare?
Okay, good idea. Example 1, Omega Inc. They have two reporting units, Alpha and Beta. At year-end, Alpha's book value, carrying amount, including its goodwill, was $500,000. The goodwill allocated specifically to Alpha was $50,000. For Beta, its book value, including goodwill, was $675,000, and its allocated goodwill was $75,000. Omega then did its analysis and determined the fair value of Alpha, including goodwill, was $480,000, and Beta's fair value was $700,000.
Okay, so how do we figure out the impairment for each?
We test each one separately. For Alpha, the fair value, $480,000, is less than the book value, $500,000. The difference is $20,000, $500K, so $180K. So impairment exists for Alpha. For Beta, the fair value, $700,000, is greater than the book value, $675,000. The difference is positive, $25,000, $700K, $670K. So no impairment for Beta. Beta's unit is actually worth more than its book value.
So Alpha has a $20,000 impairment indication. Now, how does that cap work?
Right. The potential impairment charge is $20,000. We compare this to Alpha's allocated goodwill, which is $50,000. Since $20,000 is less than $50,000, Omega recognizes the full $20,000 impairment loss. But crucially, let's say Alpha's goodwill had only been $15,000 instead of $50,000. Even though the calculated difference was $20,000, the impairment charge would have been capped at $15,000. You can only reduce goodwill down to zero.
Got it. The loss can't exceed the goodwill allocated to that unit. And the journal entry for Alpha would be debit loss due to impairment $20,000. Credit goodwill $20,000. What's the impact for Omega?
It's a direct hit. That $20,000 loss reduces their net income for the year, and the goodwill asset on their balance sheet is permanently reduced by $20,000. It signals that the expected value or synergy from acquiring whatever business created that goodwill isn't panning out as hoped. It's a significant adjustment.
Okay, this is all under U.S. GAAP for public companies, right? But here's a fascinating twist. Private companies have different options for goodwill. Why is that?
Yeah, this is a really interesting divergence. This immediately makes one wonder, why do private companies get different options? It generally comes down to cost versus benefit. Public company rules are complex and expensive to apply. Private companies often have fewer resources and maybe different user needs for their financial statements, perhaps just owners or a bank, not millions of public investors. So U.S. GAAP offers alternatives to reduce that burden.
What are those alternatives?
There are two main ones for private companies, not public or not-for-profits. Alternative 1, Amortization is huge. A private company can choose to amortize goodwill straight line over 10 years or less if they can justify it.
Amortize goodwill.
Wow.
Yeah.
This significantly changes the game. Regular amortization reduces the goodwill balance steadily, making a big sudden impairment charge like Omega's much less likely, or at least smaller. Once they choose this, though, they have to stick with it for all goodwill.
So they can smooth it out over a decade. Definitely less drama than a big impairment hit. What's the second alternative?
Alternative 2, impairment testing flexibility. Even if they don't amortize, they get flexibility. They can choose to test goodwill for impairment at either the entity level, the whole company, or the reporting unit level. And, crucially, they can test when a triggering event occurs, like a major downturn or loss of a key customer, rather than having to do it strictly annually. They can also do the qualitative check more frequently if they want, like at the end of each reporting period.
Triggering event basis.
Yeah,
That sounds much less burdensome than mandatory annual testing.
it can be. They just need to disclose which alternatives they're using in their accounting policies footnote. Both options are really about simplifying things for private companies.
That makes sense. Tailoring the rules a bit. Okay, let's shift gears now to another critical area, especially for innovative companies. Research and development, R&D costs. This is where companies invest in the future. But what's the precise difference between research and development for accounting?
Right. In accounting terms, research is about planned efforts to discover new information. The goal is to create a brand new product, service, process, or technique, or maybe significantly improve an existing one. It's the exploratory phase. Development then takes those research findings, the new knowledge, and formulates a concrete plan or design to actually create the new item or make that significant improvement. It's applying the research.
Research is discovery, development is application. Got it. So how are these costs generally treated? Expense or capitalize? I'm sensing a theme.
You're right on the theme. The surprising and often frustrating truth for most R&D costs is that the general rule is expense immediately, direct charge to expense in the period incurred.
Expense immediately. Why? Isn't R&D building future value?
That's the debate. But what's fascinating here is the why behind the rule. It's primarily due to the high degree of uncertainty about future benefits. When you start R&D, you just don't know if it will lead to a successful, marketable product. Will it actually generate future revenue? So, to be conservative and prevent companies from putting potentially worthless assets on their books for failed projects, the standard generally requires immediate expensing. This can really impact the reported profitability of companies investing heavily in innovation, like biotech or tech startups.
Yeah, they might show big losses exactly when they're building their most valuable future assets. Investors need to look past that P&L sometimes. But there must be exceptions. When can R&D costs be capitalized?
Yes, there are 3 key exceptions to the expensing rule. Exception number 1 is for tangible assets that have alternative future uses.
Okay, what does that mean?
If you buy materials, equipment, or facilities for an R&D project, but that asset could also be used for other projects or even in regular operations later on, you capitalize the asset itself, record it on the balance sheet. Then you depreciate it over its useful life, not the R&D project life. But here's the catch. The depreciation expense for the period that the asset is used in R&D is considered an R&D expense.
Ah, okay. So buy a versatile lab machine, capitalize the machine, but the depreciation while it's being used for R&D gets expensed as R&D cost for that period.
Exactly. You expense the consumption of the asset during the R&D activity. What's the second exception?
Okay, second exception.
R&D costs undertaken for others under contract. If your company is basically a research contractor doing R&D for another company under a specific agreement, those costs aren't your R&D expense. They're treated as part of your cost of sales because you're providing a service.
Makes sense. You're getting paid for it. And the third exception.
The third one involves business combinations again. It's for in-process R&D acquired when you buy another company. If the company you acquire has ongoing R&D projects that aren't finished yet, the fair value assigned to that incomplete R&D is capitalized as part of the acquisition price. It reflects that you paid for the value of that ongoing research, seeing it as an acquired asset with future potential.
Got it. So acquired R&D gets capitalized.
Right.
But what about stuff that sounds like R&D but isn't? Where's the line between innovation and just routine work?
That's a really important distinction. The sources list several things that are explicitly not R&D expense. Things like routine, periodic design tweaks to existing products, or troubleshooting problems on the production line that's usually just manufacturing cost, ongoing operations. Also, marketing research, finding out what customers want, that's typically selling expense, not R&D. Quality control testing to make sure products meet specs, also not R&D. And reformulating a chemical compound, unless it's a truly major overhaul aiming for something new, is often just operational tweaking.
So it has to be about seeking genuinely new knowledge or significant improvements.
Pretty much. Those other activities are necessary, but they fall outside the strict accounting definition of R&D.
All right, let's put this into practice with Julia Co. Tell us about their costs.
Okay, example 2. Julio Co. They had several costs. Materials used directly in R&D, $400,000. Equipment acquired with alternative future uses, $2 million. The cost of the equipment itself. Depreciation on that specific equipment for the current period, $500,000. Personnel costs for folks directly involved in R&D, $1 million. Consulting fees paid to outsiders for R&D work, $100,000. Indirect costs reasonably allocated to R&D activities, $200,000.
Okay, based on the rules, how much of this does Julia actually expense as R&D this year?
Let's walk through it. The $400,000 in materials used in R&D, expensed, consumed in the process. The $1 million in personnel costs for R&D staff, expensed, direct costs. The $100,000 in consulting fees for R&D, expensed. The $200,000 in allocable indirect costs, expense. Now, the equipment. The $2 million purchase price itself. Not expensed as R&D because it has alternative future uses. It gets capitalized as a tangible asset on the balance sheet.
Right, that was exception 1.
Exactly. But the $500,000 of depreciation on that equipment during this period while it was used for R&D, that amount is expensed as an R&D cost. It represents the portion of the asset's value consumed in R&D this year.
So the depreciation gets expensed, but not the whole cost of the machine.
Correct. So adding up the expensed R&D items, $400 materials, plus $500K depreciation, plus $1,000 personnel, plus $100 consulting, plus $200K indirect, $2,200,000. That's the total R&D expense for Julio Co. for the year. The $2 million machine is sitting on the balance sheet as an asset.
Okay, moving from general R&D to something very specific and hugely important today. Computer software development costs. This seems like a really complex area. Let's first talk about software developed to be sold, leased, or licensed commercial software. How do companies figure out when to stop expensing development costs and start capitalizing them as an asset? You mentioned it hinges on technological feasibility. What is that and how does it work?
Yeah, this is super critical for tech companies. Technological feasibility is the absolute dividing line. For software being developed to sell externally, all costs incurred before you establish technological feasibility must be expensed immediately as R&D. Think early planning, preliminary design work, initial coding experiments, basic testing, all that uncertain exploratory stuff. But once technological feasibility is established, then the costs incurred after that point, right up until the product is ready for general release, get capitalized. Put on the balance sheet as an asset. This would include more detailed coding, extensive final testing, creating product masters, and so on.
So it's like the switch flips. Before feasibility, it's R&D expense. After feasibility, it's a capitalizable asset cost. How do they know exactly when they've hit technological feasibility? What's a trigger?
It's generally established when you've either completed a really detailed program design showing all the pieces work together, or more commonly, when you've created a working model.
A working model, like a functional prototype.
Exactly. Something that demonstrates the software can actually perform its core functions as intended. This is the key turning point because it signals the major technical hurdles are overcome. The project shifts from uncertain research to a more predictable production effort.
Okay, that clarifies the trigger point. So once these software costs are capitalized, how are they amortized? Is it just straight line, like we discussed for some other assets?
Not quite for external software. This is another interesting wrinkle. The annual amortization for capitalized costs of software meant for sale is the greater of two methods, figured out product by product.
Greater of two methods, okay.
Method 1 is the percentage of revenue method. You take current period revenue, total projected lifetime revenue for that product, and multiply it by the total capitalized cost. So if it's selling fast, it amortizes faster. Method 2 is just the straight line method. Total capitalized cost divided by the estimated economic life of the software. You calculate both, and you take the larger amortization expense for the year.
Why the greater of rule? Seems complicated.
It raises an important question, right? It's designed to be more aggressive. If a product is selling really well early on but might become obsolete quickly, the percentage of revenue method will likely result in higher amortization, writing down the asset faster to match its rapid economic consumption. It aims for a better matching of expense to the pattern of benefits.
That makes sense for fast-moving tech. What about the actual costs of making the physical product, like burning CDs or packaging?
Good question. Those costs incurred to actually produce the final physical product, duplicating, packaging, manuals, etc., are treated as normal product costs. They go into inventory and become cost of goods sold when the item is sold. And one more point. The capitalized software costs themselves, sitting as an asset, have to be reported at the lower of cost or market, where market usually means net realizable value, what you expect to sell it for, less costs to finish and sell. Another layer of conservatism.
Lower of cost or market.
Got it.
Now, what about software developed just for internal use, like a custom accounting system or an internal database? Are the rules the same?
No, the rules are definitely different for internal use software. Here, costs incurred during the preliminary project state are expensed immediately. This includes things like conceptualizing the project, evaluating different options, figuring out if it's even feasible, similar to the pre-feasibility stage for external software. Also, costs for training employees on the new internal system and ongoing maintenance costs are always expensed as incurred.
Okay, so preliminary stage and ongoing stuff is expensed. What is capitalized for internal software then?
You capitalize costs incurred after that preliminary project date is completed and management commits to funding the project. This includes specific things like direct costs of materials and services, payroll costs for employees working directly on developing the software, and applicable interest costs incurred during development. Essentially, once the project gets the green light and serious development begins, those direct costs are capitalized. Also, costs for significant upgrades and enhancements that add functionality or extend the life of the internal software are capitalized too.
So that preliminary project state acts kind of like the technological feasibility point for internal software.
Yeah, that's a good way to think about it. It's the point where the project becomes more defined and likely to be completed and used.
And amortization for capitalized internal software. Is it the greater thing again?
No, thankfully simpler here. Capitalized internal use software costs are just amortized on a straight line basis over their estimated useful life, reflects a more predictable, steady consumption of the asset's value internally.
Straight line. Okay. Now, here's a quirky scenario. What if a company develops software mainly for internal use, but later decides, hey, this is pretty good, let's sell it to others? How does revenue work then?
That is a unique situation, and it has a very specific, kind of unusual revenue recognition rule. If software initially developed only for internal use is later sold or licensed externally, any proceeds received, net of incremental selling costs, are applied first to reduce the carrying amount of the software asset on the balance sheet.
So the money received pays back the capitalized cost first.
Exactly. You essentially recover your investment first. Only after the carrying amount of the software asset has been reduced to zero do you start recognizing any further proceeds as actual revenue.
Wow. So recover cost, then recognize profit. That's definitely conservative.
It is. It ensures the company gets its investment back before reporting any gain on something that wasn't originally intended for sale. Hashtag tag 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 outro.
Wow. Okay. We have covered a ton of ground today, from the often invisible value of goodwill all the way through the very detailed rules for R&D and software development. It's really clear that understanding these intangible assets isn't just for the accountants in the room, right? It seems crucial for anyone trying to truly get a handle on a company's financial health, its strategy, its future potential.
Absolutely. And these rules, as complex as they can be, really reflect the ongoing effort to try and quantify things that are inherently hard to measure. They highlight that constant challenge for accounting, keeping pace with how business value is actually created today. As our economy leans more and more into services, knowledge, brands, data, the value of these invisible assets just keeps growing. It puts real pressure on the standards to capture that reality accurately.
So what's the big takeaway for everyone listening? I guess next time you look at a balance sheet or read about a big tech acquisition, remember that a huge part of the story might be hiding in plain sight within those intangible asset lines. And it definitely raises an important question, doesn't it? As the economy evolves, are these accounting standards fully keeping up? Are they truly capturing the modern drivers of wealth and innovation, or is there still a gap?
That's the multi-billion-dollar question, really. And think about how these intricate rules might subtly nudge company behavior decisions about acquisitions. How much to budget for risky R&D versus buying existing tech, how profitability gets reported. It's a fascinating area that goes way beyond just the numbers. Lots to keep exploring.
Absolutely. Well, on that thought, we've reached the end of another deep dive.
Great.
Thanks so much for joining us on this exploration of the invisible, but absolutely invaluable.